This is Bloomberg Intelligence.
We're really getting into now the streaming's arms race.
Dish is looking at that and saying we can really build a nice niche for ourselves.
In-depth research and data on 2,000 companies and 130 industries.
The dollar is the dominant concept in the planet.
I think the acquisition is a natural progression of what Microsoft can do with this technology going forward.
Bloomberg Intelligence with Alix Steele and Paul Sweeney on Bloomberg Radio.
Over the next hour, we are going to dig inside the big business stories impacting Wall Street and the global markets.
Each and every week, we provide in-depth research and data on some of the 2,000 companies and 130 industries our analysts cover worldwide.
Today, we're going to take a look at real estate and if European REITs can beat their 7-year slump.
Plus, we discuss whether gender diversity in the boardroom helps returns.
But first, we got some big bangs on Friday. Yeah. But global asset managers, now they are going to be really interesting. They're going to feel the pressure as markets and the mix may squeeze margins this year. So we want to get a view on what to expect from Alison Williams, Bloomberg Intelligence Senior Banks Analyst. Okay, global asset managers, what's your biggest call for them this year?
Well, I think there are probably 2 points of interest if we look at the industry broadly. First is that active managers may still have a pretty good environment to play in.
So they keep telling us.
Well, we had a long period after the financial crisis of underperformance, and that also coincided with this very long-term secular trend of passive taking share. So we do think that the trend of value for money continues.
I can't see any reason to go near these asset managers just simply because of that secular wind you mentioned. Every day it just seems I see more stories about more money going passive, ETFs here, ETFs there. Do I even need to go to Boston anymore and see my mutual fund clients, Allison, like we used to do 2 to 3 times a year?
So 3 points to you.
Okay.
You should go see your Boston clients,
Okay.
but they will have less assets.
Okay.
2, active managers do have the winds in their favor in terms of rates are high, equity returns are low, and there's volatility and lower correlations. But you heard me say asset class returns are low. That is not great. And finally, even though it's a great environment, this trend towards lower fee will continue. And how that is playing out for some active managers is selling their product in a different structure, so a lower fee wrapper. So we hear about all of these transparent ETFs and active ETFs, et cetera, et cetera. What that basically means is same returns, lower fee, perhaps more tax efficiency.
So how are these guys positioned if we get a huge downturn this year? I appreciate that global asset managers have been around for a really long time, and they've been through down cycles before. But then we hear about, there's just so much money. There's so much leverage. They haven't seen this kind of downturn with this kind of leverage before. What's your take on that?
The private markets are going to be tested. And
so we're talking like the KKRs, the Blackstones,
exactly.
Like Carlyle.
Exactly. And private equity, as we know, has been, forever a great business. Private credit has really been the business of the last decade, really a lot of excitement around that opportunity. And when we look at the banks and we look at the private markets, we see that a lot of the lending, if you will, is in that second bucket, right? So it's moved away from the banks. So we think there are going to be credit issues this year, but we do think a lot of the action takes place outside of the banks, and it happens at a lot of these private credit firms.
For the traditional asset managers out there, the T. Rowe Prices of the world, the Janices, is there going to be consolidation if for no other reason I got to cut costs, I got to get scale?
Paul, how long have we been talking about consolidation in the asset management industry? And why do we always talk about it? Because you look at a piece of paper and it makes complete sense.
Right.
You can leverage these costs, scale. If a PM's managing $1 billion, why can't they manage $3 billion? And certainly there are arguments against that in terms of looking for opportunities. But the biggest argument, the biggest impediment is culture. And so when I talk to our ETF analyst, he will always say, why can't X just merge with Y? And they're completely different firms, completely different cultures, and you really do have to find that fit. And then, by the way, some of these managers, which are showing stress in their business, that have outflows. When you combine two businesses like that together, things don't get better. They get worse.
Right. So then let's tie these 2 points in together. So you have that point as well as these managers are going to be tested. What's the fallout?
I think there will be more pressure to merge. So again, we've been talking about this forever, but we're now in an environment where fees have been under pressure forever. As I said, now they're even coming for the active managers through these different price of products. I think that managers just do have to try to intensify their search a little bit more. So those problems need to be addressed. It has to be done the right way. You do have to have a cultural fit. You're not going to improve outflows by combining a troubled manager with a healthy one. But you do have to look around at your choices and think about, are there ways that we can combine with someone with a similar culture and get those cost synergies? Because equity returns, unfortunately, are not going to be like 2021.
Yeah, and it's going to be a really, really tough environment as well with all the leverage out there, too. Thank you, Alison. Really appreciate it. Alison Williams, Bloomberg Intelligence, Senior Banks Analyst.
All right, let's turn our attention right now to the North American consumer hardline business, where the divide in demand across discretionary categories is likely to extend well into this year. For more on that and what to expect, we're joined by Bloomberg Intelligence REITs and consumer hardlines analyst Lindsay Dutch. So, Lindsay, talk to us about the hardlines business. What is in that universe of coverage, and kind of what's the call for that sector of the retail space?
So the hardline sector obviously spans a wide range of categories. And the way I'm thinking about the sector heading into 2023 is, some of the pandemic winners, electronics, home, outdoor, toys, even some sporting equipment names, they had started to show some challenges in 2022, especially in the back half. And I think that can kind of extend this year, that demand pullback that we saw. Consumers are really prioritizing their spending in other areas. And one of those also falls in hard lines, and that would be something like an Ulta, which covers beauty products.
So if revenue's kind of dropping off, what do their margins look like then for this year? What's the visibility with that?
Yeah, so margin is definitely a focus for 2023, and it's an interesting story because we are seeing, some easing in terms of freight cost pressure and even potentially on the inflation front. But towards the end of 2022, we really saw a much higher level of promotions and discounts than we've seen in the past couple of years. And we kind of expect those discounts to continue this year, and that will pressure margins sort of across the board.
Some of the management teams of these retail companies, what are they saying about a typical recession cycle, and how do they prepare for it? Is it lower inventories? Is it just being more aggressive on pricing to move inventory?
Yeah, so they're definitely being more aggressive on bringing the consumer into their stores, whether it be by deal days or online sales that they can offer, anything that they can bring the consumer into the store. But thinking about that beauty category, which has been outperforming, beauty generally is typically recession resistant. And even with that sort of backdrop, the sales growth that we've seen from a company like Ulta, double digits in 2022, it still is widely exceeding expectations. Just very, very strong growth in that category, despite the economic backdrop.
What happens if the economy turns for the worse? I know we're kind of expecting it, that top line to come off a bit, but I'm wondering, who has the levers to pull and who is really going to be in some trouble?
I think a lot of these big companies, if you think about a Best Buy, electronics demand, there will be a lot of pressure there, but the management team is really good there. They have a very strong balance sheet, and I think it's just sort of gutting through this difficult time. I don't think that you can take a read from a company like Bed Bath & Beyond, which is potentially going to enter bankruptcy and sort of apply it to the... Exactly. I don't think that case can be applied to the whole sector. It's really a one company type of story. I think a lot of the big names in this hardline space, really have solid balance sheets, and that's going to be important in 2023 and making it through this year.
How's the consumer credit, and how does that impact these retailers here? Because there is some concern that consumers are pulling down their savings, putting more stuff on their credit card.
Yeah, that's definitely a concern, and something to watch. I think again, especially on like electronics and home, they're more exposed on some of those like bigger ticket items versus companies that sell much smaller basket sizes. Again, like an Ulta or a Bath and Body Works. So I think a Best Buy, Williams Sonoma, RH, all those companies that really have high ticket items. That's a risk, and that's something that they definitely need to be watching out for this year.
All right, Lindsay, thanks a lot. We really appreciate it. Lindsay Dutch, consumer hardlines analyst and REITs analyst for Bloomberg Intelligence.
Coming up on the program, can gender diversity in the boardroom really impact returns?
You are listening to Bloomberg Intelligence on Bloomberg Radio, providing in-depth research and data on 2,000 companies and 130 industries. You can access Bloomberg Intelligence through BI Go on the terminal. I'm Alix Steele.
And I'm Paul Sweeney. This is Bloomberg.
This is Bloomberg Intelligence with Alix Steele and Paul Sweeney on Bloomberg Radio.
While a backtest of gender metrics such as women on boards has shown little evidence of return benefits across regions, some areas like the U.S. and Europe have had better luck. To help us explain why, we're joined by Bloomberg Intelligence senior ESG analyst Shaheen Contractor. All right, Shaheen, diversity of boards, women on boards. What do the numbers show in terms of actual returns for those companies?
So, Paul, great question. So, the first thing we see is, as you mentioned, few regions show return benefits. The US and Europe are one of them. What I think is really interesting is sort of the difference between the two. So, if you look at the US, for example, the way it works is screening for the worst performers can add value. So, in other words, companies with the lowest share of women on boards have the lowest returns, but it's not linear. So, it's not like higher diversity equals higher returns. But in Europe, it is exactly linear, so go figure.
Right.
And not many other regions, like APAC, doesn't seem to have many benefits. There's no link. And that's a shame, because that's where it's needed the most, right?
So, what's your takeaway? What's the feeling within the ESG space about women on boards just in general?
So, if you think about diversity, it's the benefits of diversity in general.
Okay.
I think the way I see it is maybe this calls for a deeper analysis into diversity as not just women on boards, like more than that.
Okay, so then if I'm a CEO or I'm someone on the board and I want to diversify, what do I learn? Like, what's my takeaway? How do I convince people around me this is the right way to go?
So the one thing I say, though, is though we didn't see, a clear return benefits, there was a little bit of a sort of low volatility, and we saw that across all regions.
So lower volatility if your board's very diverse.
Across all regions, correct. That being said, there could be a causation, there couldn't be a causation. We can't really go there. But I think it would be, thinking of diversity not just at the board level. Board level is important, but also throughout the firm. People normally just start at the top and call it a day, I guess is what I'm saying.
So I remember in California, they had a rule that required gender quotas on boards, but that was struck down by the courts. Tell us kind of what happened in California.
Sure. So California sort of followed Europe's footsteps. So Europe traditionally, many countries have had a certain quota in terms of what they have to maintain in terms of women on boards. California was the first U.S. state to do that, and that just got struck down. They called it unconstitutional. And basically, NASDAQ had a similar rule. That's contentious right now. So the U.S. is sort of taking a step back.
All this diversity stuff, whether it's in the boardroom, in your employee ranks, is that going to be driven by just shareholders, by the marketplace? Because it doesn't seem like perhaps the regulation route might be the way to go.
Regulation does seem to be working. The U.S. seems to be an exception.
Right.
Because it worked in Norway, right?
It worked in Norway, yes. Norway has had this board quota since 2008. There are many other regulations taking hold. Japan has a new pay gap disclosure rule. The U.K. has this new rule on, I'm forgetting what it is. I think it's something like you have to meet a certain threshold, and if you don't, you have to explain why. Mm-hmm. So there's a lot going around the world. The U.S. is just an exception.
So talk about regions then. What regions are doing successfully with diversity and which ones are not?
So I think the UK, Europe are great examples, right? The UK with its new sort of pay gap disclosure, not new. They've had that for a while. Japan has just emulated it. I think those are really good examples of sort of how we can push this forward.
Let's talk more broadly about ESG. How did it perform as a factor in 2022 relative to the general market? Do you feel like it's gaining momentum, losing momentum? Kind of where are we?
So performance was bad, as we all know.
That's more the correlation with tech, though, right?
Yeah, of course. ESG is underweight energy. Energy did great. So, of course, ESG did badly only because of tech energy kind of dynamic. In terms of, if you mean, the interest relating to like asset growth and things like that. So, Europe has sort of chugged along. There's been no decline. The US saw flows decline 90% for ESG ETFs, 9-0.
Wow.
It's pretty tremendous.
But here's the thing. If ESG can't de-link itself to tech, how is it ever going to be its real own asset class?
It's a very good concern you have. I have the same concern. Why should ESG be more tech and less energy? That ESG, in my mind, is a fundamental decision. There's no way it should be that way, but it is.
Right. But also, when the returns are going to track tech, just go buy the triple Qs,
correct.
For example.
So I think the long tech, short energy is a general view of how ESG is. There are funds that do differently. There are funds that do many different things, but that is the consensus.
Now,
that is sort of generalist.
The fund flow, that 90% number in the U.S., the funds flow declining 90% from the prior year, do you feel like that was driven by just the market itself, people just kind of getting out of tech, getting out of all that kind of stuff, or can you track it back to anything more fundamental, which is, all right, we tried this ESG thing, we're not really buying it. The Europeans, they seem to be more into it.
So, Paul, I think the decline in ESG has nothing to do with ESG.
Okay.
So basically, the US decline, in my mind, is 3 reasons. The first one is concentration risk. Now, the fact that for the last 2 years, we've seen, 3, we've seen assets grow due to these large, chunky allocations from institutional investors. When that stops or goes out, it's very noticeable. Because think about, like, one fund will suddenly have $1 billion allocated to it. And when that flow goes out, it's very noticeable. Right? So that's one, the unraveling of concentration risks. And the example I have is of this fund, the iShares EM ESG fund. And its assets one day dropped 90% because its largest holder decided to switch strategies away from EM. So nothing to do with ESG. But if 90% of your assets is one fund, you have a problem, and it's very noticeable when it goes out. The second is clean energy. Clean energy saw the highs of last year, but coming back to averages. So that decline is being noticed.
With clean energy, though, in particular, I mean, there's going to be a lot of money coming from DC in terms of subsidies. Potentially in Europe as well. Like, they're pretty upset about the U.S. IRA, so Inflation Reduction Act. So maybe they'll put more money into it, too. Do clean tech funds that would be considered more ESG, like, do they follow this trend? Like, can you play that money flow with those kind of funds?
No.
Okay, fair enough.
Right. So clean energy spiked last year when President Biden came in, and everybody sort of anticipated favorable clean energy policy. I don't know if that makes sense. They anticipated the IRA, and hence they sort of drove it up, and it was about 10x last year versus any other year, and was sort of coming back to averages because people have already priced that in.
All right, so we flipped the calendar, new year 2023. What are some of the big themes that you think are going to drive the ESG space this year?
So the first is concentration risk. I think that's going to drive a cyclicality in flows. And what that means is, with these large one-off allocations, we will keep seeing a rise and a down and a rise and sort of it going down. That's one. I think the second one is engagement, so proxy voting. Investors are constantly voting with their feet today, and there's a lot of talk about proxy voting as sort of creating change.
Proxy voting, saying, I'm going to vote for positive ESG
Correct.
movements.
Like there are many funds now that basically vote against the management of a company if they don't have at least one director as a woman.
You don't have to be like an activist investor then to do that.
No, it's just general, like BlackRock, Vanguard type.
And they're really putting their money where their mouth is with that? It's not just talk?
No, and actually we saw the first fund, like Vote to US, is of ETF that holds the S&P passively, but they only engage.
Is there also, before we let you go, like an anti-woke thing also happening that we need to focus on?
A lot. I mean, you can see that in the anti-ESG funds that are coming up. I mean, you have the Orphans ETF, you have Bad US, I feel like that's one of it. We have anti-ESG proxy resolutions coming in, companies that are basically saying you can't have racial audits, it's unconstitutional. Not companies, sorry, investors. Right. So a lot of it.
And there's one, DRLL, drill. And, yeah. And that's basically just saying, forget all that green energy stuff.
Just give me all
make
energy.
profits. Just make profits. And if
Yeah.
it's drilling a hole in the ground, so be it. All right, good stuff. Our thanks to Bloomberg Intelligence Senior ESG Strategist Shaheen Contractor.
Coming up on the program, we're going to discuss what comes next for European real estate. That's after 7 years of bad luck.
You're listening to Bloomberg Intelligence on Bloomberg Radio, providing in-depth research and data on 2,000 companies and 130 industries. You can access Bloomberg Intelligence via BI Go on the terminal. I'm Paul Sweeney.
And I'm Alix Steele. This is Bloomberg.
You're listening to Bloomberg Intelligence with Alix Steele and Paul Sweeney on Bloomberg Radio.
We'll be here each and every week at this time, tapping into our Bloomberg Intelligence analysts covering some 2,000 companies and 130 industries worldwide.
Let's turn our attention now to European REITs. That's right, real estate investment trust over in Europe. What does their future look like if you're looking at a European economy that's in a recession and you have high inflation? Let's get to it with Susan Munden, Bloomberg Intelligence senior property analyst. First off, just to kick it off, how did European REITs do in 2022?
Oh, they did quite poorly. Yeah, it was a very bad year. Against the index, they were down about 20-30%. Quite a lot of them ended the year off, between 30 and 40%. A lot of the stocks. So it was a really poor year. It started going down when we had the invasion from Ukraine and interest rates started rising.
So, I mean, it's not just last year; it's 7 years. So why have REITs been so out of favor in Europe for such a long period of time?
They've been hit by one thing after the other. So, we've had the 2012-13 recession in the UK, then we moved on to Brexit, then we moved on to COVID, and then we moved on to, interest rate hikes this year. And each of those has hit them. And on top of that, we've also had some structural problems. So retail has obviously moved from being just one distribution channel, which was from property, to online distribution, and that's seen retail really struggle over the last 5 years. And then we've had, on the other hand of that, we've also seen the industrial REITs have a complete resurgence. They always used to be the sort of not very popular part of the property market, and they turned into the darling in the last 4 or 5 years.
So then set us up for this year. So that's the last 4 or 5 years. That was particularly bad for last year, down 20-30%. This year, the possibility of higher rates from the ECB, potentially, though, a peak in inflation, and real question marks as to growth. What's your outlook?
Well, it's an uncertain outlook, but I sort of try to picture it in terms of what's happening in the underlying market and then what has been priced into the stock market. So if we sort of look at the stock market first, and the shares of REITs are typically trading between 40 and 45% below their net tangible assets. That's their book value adjusted for the latest property valuation of their portfolios. So that would have been in September or June last year. So they're pricing in a property market fall of between 25 and 35%. That's, adjusted for gearing because, obviously they've got leverage in there to change those numbers. So the market's pricing in quite a lot, but the property prices haven't really started going down. In the valuations we got from September, and that's only a handful of companies, some areas of the stock market, of the property market, we saw marked down quite a lot. For example, offices in the City of London were down 10% at Landsec. So it started to move in, but not very much. But we will get property valuations in the reports that we get for the December year ends in February, and then we'll get some more in May from the March year ends, and then we'll get some more in August and November. So we've got those property points to look at. And each time, as the property comes down, the net tangible assets go down, so the discount to their share price narrows. On the other hand, we've then got the recession and all those things that you say. We haven't seen any peak yet inflation may arguably be peaking in Europe and the UK, but we haven't seen the peak interest rates yet. So until that happens, the market's going to be incredibly sensitive to anything dovish from any of the central banks, including the Fed, as it turns out. And obviously anything hawkish is going to go the other way. The same with GDP data, any macro data. The market for real estate is going to be very, very sensitive.
How about some of the subsectors within kind of real estate, whether it's offices or malls? I mean, how do you split that up, and are there relative opportunities between those subsectors?
Yeah, I mean, look, there has been a big spread even within, the declines we saw last year. and there will be this year as well. And again, it's sort of slightly not what you would expect, because sectors that have maybe been fundamentally quite strong, companies that held up very well last year, like Klépierre, for example, which is a retail company, they're not perhaps going to be involved so much in a bounce as the others that were marked down so strongly. And also, we've had the situation where, as I was talking about earlier, we said that retail had a very difficult 5 years. So the valuations of those properties are already on yields of 7, 8, 9%. So even if interest rates, which are the main drivers of those yields, go up to 3 or 4% on a sort of longer-term basis, in fact, the 5-year money is 3.5% for the UK at the moment, there's still a big cushion if you've got a yield of 7 or 8%. So those property prices might not move that much, which means there's a much bigger potential for them to go nearer to their net asset values by the share price going up rather than the NTA going down.
So what about another area like office space? You have the work from home scenario, but then you have, say, the likes of France taking a lot of office workers, say, from London. How did these REITs wind up shaking out?
Well, in Paris, the market has seemed to be quite robust in terms of leasing. There haven't been many transactions in the fourth quarter, but it was holding up quite well, certainly towards the third quarter. However, the yields there on prime offices in centre of Paris are under 3%, and 5-year money is already at 2.5%. So that gives you very little risk premium for your property, which really means you'll probably see that moving out. And obviously, when it's on a lower yield, even a smaller increment, basis point increase in the yield on the property makes quite a big difference to the valuation. So we might see, and we've seen that a bit in the industrial sector, where again their yields had collapsed down to the sort of 3% level. And, well, not collapse, it's a good thing, but it looks from the data that we're seeing coming through, and there's very little of it because the liquidity's just gone out of the market altogether. But the data that we're seeing coming through is seeing at least 10 or 15% on industrial prices as well. That having said that, 2021 was a really bumpy year for industrial. It went up 40%. So, there is quite a lot of froth in that market to come out.
How about the logistics markets? I'm thinking all the warehouses that the Amazons of the world need. What's your outlook for that sector?
Well, actually, Amazon's just announced the closure of 3 big industrial facilities in the UK this last week. So,
so it's not good.
No, it's not brilliant. I think the number of people being made redundant was in the thousands. So, not good. And that's all part of the UK as well. But I think there is still some underlying demand. But yes, I agree with you that as the retailers are beginning to find that online distribution is much more expensive than having a shop, they're trying to steer their customers more to go and click and collect. And also, we seem to have hit sort of peak online distribution numbers in terms of volumes. So that means that we don't really need that much more. So there will be ongoing demand, but I think that sort of structural change, certainly in the UK, to online, has probably more or less completed its sort of cycle, whereas in Europe, that's probably not the case in all the countries.
Susan, we really appreciate a lot to get through there. Susan Munden, Senior Property Analyst over at Bloomberg Intelligence. Thank you very much.
All right, let's turn now to the home and personal care space, where persisting cost of living pressures are likely to drive more frugal shopping. For more on this, we're joined by Bloomberg Intelligence Senior Luxury Goods, Beauty, and Home Care Analyst Deborah Aitken. So, Deb, inflation's out there. It's impacting everybody's pocketbooks. When you talk about personal care and home, what are you seeing in terms of the trends of what consumers are buying?
Right. So we get the IRI data every month, personal and for the U.S. markets, and personal and home care actually they're running relatively positively in terms of it's all pricing. So you're seeing around 7% growth coming through, which is eroding volume maybe 2-3% depending on the sector, but net 7% growth. And what's happening is, if we think about last year into the second half of last year, we saw teens even higher cost inflation, and part of that was netted off with the way that companies operated. So home care is doing okay. Some of the subsectors, like maybe a spot cleaner in laundry, that isn't going to be bought, or maybe you're not doing your laundry as much and maybe you're putting a few extra items into the bowl type of thing. But overall, we're seeing generally positive trends.
So let's talk about performance and dividends and return to cash shareholders. What can shareholders expect and what kind of upside do you see?
Right. I think sizable bolt-on deals are popular. 2022 across the HPC sector, there were over 50 deals. That's on pace still with the last 3 years. If we think about what to expect, it's quite interesting actually, because we can look at the home care companies. What will P&G do now we have the spin-off from GSK of Haleon in consumer health, J&J going into the IPO process to follow suit. So what does P&G, what do Reckitt and others do in consumer health? In beauty, we can see Estée Lauder doing things like the acquisition of Tom Ford to come through. So focusing into luxury beauty more. And I think licensing out of apparel and accessories means that these types of companies in beauty in particular can spread further afield, because we already know that the luxury companies are encroaching into the beauty and the fragrance space themselves. So I think there'll be a lot more collaborations, joint ventures, and lots more licenses swapping hands too.
Talk to us just a little bit about China. I mean, have you changed your estimates? Have you seen estimates change here? Because this reopening from China has been much faster than anybody thought. And I've, reading your research and talking to you in the past, I know how big China is, in the consumer space, particularly the luxury space.
Yeah, that's right. So we used to say, yes, we kind of rewrote the luxury goods outlook at the end of the year into the beginning of January through the break when we saw 8th of January, these borders are reopening, because the first thing is domestically we're seeing flights, we're seeing those being booked. And not only for luxury, where there are lots of stores, so store reopening, that's all positive for the luxury space, but also when it comes to the beauty industry, the fragrance industry and others, we have Hainan and others reopening, so lots of duty-free purchases and others taking off, all positive. When we look at China overall, then we would say, it used to be up to a third of the luxury business. A quarter was purchased at home pre-COVID in domestic China, and the rest was when travelling. That reverted back to China through the lockdowns from 2020, and we probably lost half of that with closures. Since the start of the year to date, across the beauty, home, personal care sector, we have L'Oreal as outperformer, leading market share improvement with 10%, followed by Givaudan and Estée Lauder. So the beauty companies are the ones that are really popping into this first month on the news.
Deb, talk to us just about the profitability of the personal retail space you cover here. How much is the inflation really impacting their margins, and what's your outlook for 23?
I think if we look at what's happened in home and personal care in particular, beauty has continued to raise its margin, except with Estée Lauder as a one-off, separate from that and having to go through some level of strategy rethink in some parts. But we think about L'Oreal and others and what they're doing, and generally they have absolutely managed their margin, protected their margin and continued to grow. In the home care space, it has been a case that for Procter & Gamble, for Unilever, for the US exposed companies to pulp and packaging, paper freight, they've seen maybe 300 to 400 basis points of margin erosion. But we are seeing hedging coming back. We're seeing prices being accepted. We're seeing that inflation will start to come off through the second half of the year and hedging will grow. And so by 2024, hedging will rise as part of the mix. And so by 2024, we're seeing that we will have mid-23 hit a base on margin and be growing that margin back through 24 with full recovery, depending on whether it's fiscal or calendar, end 24 into 25.
All right, Deborah, thanks a lot. Really appreciate Deborah Aitken joining us, luxury good, beauties, and home care senior analyst for Bloomberg Intelligence.
That's this week's edition of Bloomberg Intelligence on Bloomberg Radio, providing in-depth research and data on 2,000 companies and 130 industries.
And remember, you can access Bloomberg Intelligence through BI Go on the terminal. I'm Alix Steele.
And I'm Paul Sweeney. This is Bloomberg.